Howard Green. Well, Alex, I want to start with you briefly on this news that came across just an hour or two ago about Anglo-Irish Bank Corp going to be split up into a funding bank and asset recovery bank. Can you briefly explain the significance of that?
Well, it's not surprising that this is starting to happen. I mean, when you get into a default cycle, as we are right now in very early stages, the typical action you take is you ring fence all of the bad assets in what you call a liquidation estate and try and deal with them, and then you have the good bank go on and have a life of its own. This appears to be what's happening. It needs to happen to a greater extent pretty much across the continent. I think that's what the concerns about the stress tests reflect. They reflect a concern that not all of these banks are solvent. And I think the Irish are taking the bull by the horns here. We do know that there are a lot of distressed assets on that particular bank's balance sheet. And so this is what they're doing.
A brief follow-up to that. Do you anticipate other situations like this, other banks split into so-called good and bad banks?
Well, yeah. I mean, if the authorities want to take the bull by the horns, they're going to have to do this not only in Ireland, but they're going to have to look to Germany, where there are a number of sick banks. They're going to have to look to Italy. They're going to have, in particular, to look to Spain. And for that matter, the United States has got a lot of sick institutions, and the full impact of that problem has not been fully reflected or disclosed to the markets yet.
Bob,
the astonishing thing is how hard the establishment is trying to keep it all together. First of all, you had problems with the rating agencies. Now, on whether they're rating sovereign debt or corporate debt, they're always very reluctant to do the final downgrade to non-investment class, because that then pushes things further. And then also, I believe these stress tests were designed not to find a problem. So they choose their countries, they choose their banks to do the stress test on to come out with positive results. And the market will probably adjudicate it quite harshly eventually.
You know, before we discuss the stress tests a little bit more, Alex, what about your view of a Greek default? The odds in your view?
Well, to look to the odds, I mean, you look to the market spreads that you referred to, Howard, and what those spreads imply is a 5-year default probability of around 45 to 50%, which in statistical terms means it's probably going to happen. It's like a coin toss. So you have a very high default probability with Greece and with a number of the other sovereigns, Argentina, Greece, Spain. One of these guys is going to fall over. It's just a matter of time. The economic performance in Europe is very uneven. This is not contributing to, robust government finances. Government finances are under increasing pressure from the interest payments that governments are having to make on these higher debt burdens. And it's just a matter of time, in my view, as to when one of these countries is going to crack.
Is the market ready for one of these to crack?
Well, I think the market's very nervous, and I think what Bob was referring to is the fact that the authorities have been through these stress test mechanisms and other forms of public relations trying to keep market expectations on an even keel. But markets are getting skittish, as Bob pointed out. That's being reflected in widening spreads, and I think we're in this type of a short-term trend. Whether it's going to take us all the way to somebody defaulting in this round, I don't know. But certainly from a longer-term perspective, I don't see all of these countries coming through this unscathed.
You know, I want to come back, Bob, to the bond market, the bond market's reaction to all of this, because the IMF said something quite interesting, and I want to get your reaction to it, that the data show that bond spreads led to false alarms in the vast majority of episodes. Quote, in our view, the risk of debt restructuring is currently significantly overestimated.
Oh, I think that's whistling past the graveyard. There have been times of absolute panic in the financial markets. 2007, when the subprime mortgage bond disaster started, the authorities said it was an isolated event, simple management, keep it contained. Then you went into 2008 and you had the crash in corporate bonds. Then more recently, the last 9 months or so, you've had the similar distress in sovereign, and there's only one thing left, and that's the U.S. Treasury market that one might think risk could be discovered.
Alex, the IMF's view?
Well, I think the IMF has got a certain political angle when they make these pronouncements. They're certainly not going to say something inflammatory and something damaging to market stability.
But they're the ones that usually have to go in and mop things up.
Well, historically, they have been involved in these incidences where you've had sovereign default, and certainly they don't want to do anything to promote increased expectations or fears of a sovereign default. So they're going to try, along with everyone else, the European Central Bank, the Fed, everyone else, to try and keep these expectations in check. But the longer this process goes on, weak profile of economic growth, a lot of dry tinder around in the form of risk, certainly in the U.S. and in other economies, these fears are going to persist, in my view. See, and I don't think we should forget the fact that the accumulation of a lot of these sovereign bits of sovereign debt was actually encouraged by the bank capital rules, which gave us zero risk weighting to AAA rated assets, and most of these sovereigns were AAA, so banks were actually encouraged to go out and load up their balance sheets with this type of debt. And now that the market has turned, banks are finding that these assets have now become less than what they paid for them, and it's become a source of risk.
Kind of ironic that they were encouraged to go.
Well, that's a perverse impact of these capital rules. You know, that's what you get sometimes, and now we're living the result of this situation.
But was part of that encouragement from the ECB, hey, banks, go out and pick this stuff up. We want you to help stabilize the system, and now they're stuck with more of it.
Well, yeah, to a certain extent, but more generally, over the last 20 years, the Basel rules have tried to move capital allocations to a risk-based standard. Now we're finding as risk is increasing, and most of the banks have a lot of this risk on board, you're finding that capital levels are coming under stress. This was not foreseen. This was not foreseen by the architects of the Basel capital rules. They didn't foresee that a lot of countries could get into trouble at the same time, and that this could cause capital adequacy problems in a lot of banks. But that's what we have now. And, well, there's a flight to quality going on, definitely, and that's why you're seeing the Treasuries have a good bid again. But more generally, I mean, we're in a situation here where the authorities have tried to combat what is essentially a solvency problem, a global solvency problem in the banking system, by adding a lot of liquidity. And you can't solve a solvency problem by pumping up the money supply. You can, the money supply, that money growth will support some level of activity, but in the end, as Bob says, you're going to have to work off these malinvestments, these bad debts that were created during the boom phase, and that's something that could take quite some time. Certainly, if you look at the U.S., there hasn't yet been a recognition that this has to be done, and done aggressively. You cited the Ireland example, where they're starting to take steps to fix up their banking system. Well, in the U.S., they haven't taken such steps. In fact, the problem in the banking system in the U.S. has largely been masked by the suspension of the mark-to-market accounting rules back in April of 2009. We don't know how many bad banks there really are. The FDIC is telling us that there are about 829 on their list, but I can assure you that our analysis and certain other people that are looking at this situation suggest there could be as many as 2,000 bad banks, insolvent banks, banks that can't be
out
helped.
Of 8,000 in the United States.
There are about 7,900 banks, that's right, in the States. So about a third of the banking system is zombified.
But let me just follow up with that question I asked Bob. I mean, what are the appropriate capital ratios? I mentioned what these proposed ones are in Basel, but obviously the German banks are a little bit nervous because their banking association is saying they're going to have to raise collectively another 105 billion euros.
Yes, and that's the situation for a lot of banks. A lot of banks are going to have to raise additional funding to cover what are shortfalls in their capital bases. You know, is the market going to be producing those funds in the amounts required? Well, if things are kept a secret, if the true condition of bank balance sheets is not fully disclosed to investors, banks are going to have a lot of difficulty raising those monies. I would argue that that's the case in the U.S. right now. I wouldn't want to be a bank treasury officer trying to get funding in, term funding or capital funding in for my bank if I was a U.S. mid-sized bank right now. The market is extremely difficult, if not closed.
So Bob, the National Bank of Greece, as I mentioned in the intro, is looking to sell shares and convertible debt to raise $3.6 billion. Would you buy any of that convertible debt from a Greek bank?
Howard, I wouldn't even buy it with your money.
Well, thank you.
Off the books.
Yeah, and the more that process of debt restructuring is resisted, the longer this thing gets stretched out, and the more potential damage it can do. If the bull is taken by the horns by the authorities, and they promote a restructuring of all these bad debts, this problem, could feature a very short, sharp, additional downshift in the economy. But after that, as these debts get worked off, you'll be starting with a clean balance sheet for most of these institutions, and you can get the thing going a lot quicker. What's the policies that are being followed right now are extend and pretend policies that promise to drag this whole thing out, this process of debt restructuring and bad debt liquidation, much longer than it should actually be dragged out.
Headline mailbag.
The people in Bob's life count on aspirin to relieve their many different